Hello everyone and welcome to Chapter 6. In this chapter we are going to be continuing on and looking at merchandising inventory. So we started this in Chapter 5 and we will finish it now in Chapter 6. So before we move on to the new stuff in Chapter 6, I just want to do a really quick example about what we discussed in Chapter 5. So in Chapter 5, our focus was on the perpetual inventory system. And remember that the perpetual system is where we are continually updating our inventory amount. So we saw there, anytime that we recorded purchases, if we had freight in, if we received a purchase discount or had purchase returns and allowances, when we recorded those entries, we were always using the inventory account because we wanted to continually update that balance. And in the same sense, when we sold some sort of inventory, we had to do that entry to move the item out of inventory and debit cost of goods sold. So whether we're purchasing or selling something, we were always updating our inventory account. The periodic system that we discussed just briefly, that was the system where we did not have that continually updated inventory balance. Instead, amounts went into different expense accounts. And then at the end of the year, we would do the inventory count. And at that point, we know our ending inventory amount and we update our cost of goods sold and inventory based on that. So with periodic, we looked at that long calculation of cost of goods sold. So we started with the opening, added our purchases, and so on. Eventually, we got to our cost of goods available for sale, and then we subtracted our ending inventory from our count to calculate our cost of goods sold. So like we did in Chapter 5, in Chapter 6, we're going to be focusing on the perpetual method. So we will look at different costing systems and we'll focus on perpetual. Okay, so there's 3 different types of costing methods that we're going to use. What's called specific unit cost. The second is called FIFO, or first in, first out. And third is our moving weighted average cost. So in Chapter 5, and just in general, we discussed having or knowing the value of inventory. And we said that under both perpetual and periodic, at the end of the year, we would always do an inventory count. So when we look at these formulas for ending inventory and cost of goods sold, you basically just take the number of units that you have or that you've sold, and you multiply it by the unit cost. So the number of units here, this is the easy part. For ending inventory, both perpetual and periodic, we do the count. So we count our ending inventory, we know the number of units. And when we're selling goods, if a customer comes through and they buy something, we know how many units are being sold. So every time we make a sale, we know the number going out. So this number of units, that's the easy part when we're looking at these formulas. But what's more complicated and what we're going to look at in Chapter 6 is knowing what the unit cost is that we apply to each unit that we either have on hand or each unit that we sell. So when we did our journal entries in Chapter 5, the question would always tell us when a sale was made, for example. This many items were sold and this was the cost. Now in Chapter 5, we're going to dive into how we actually came up with the unit cost and therefore knew that amount to use in our journal entries. Okay, so next video we will dive into each of those unit costing methods.